And thank you, ladies and gentlemen, for getting up very early to join us for breakfast today. And thank you very much to our host, Chicago booth, for allowing us to use this excellent facility. I'm delighted to be in conversation this morning with Blue. I know you've had a copy of his CV, so I won't go through such a long and distinguished career, but it is a great pleasure to be here with you this morning, Blue. Thank you. As our first speaker said, we are going to be asking you questions as well. So this is not about Blue and I in conversation. That may have been billed as that, but this is very much about dialogue and discussion. And what I'm hoping to get out of today is to share some thoughts, perspectives, and to hear your views as well. So please ask questions early, ask questions often, and that way we'll get the most out of the time that's available to us. But let's kick off with perhaps the biggest issue facing the city and our nation today, which is the interesting, strange discussions that we're having across the UK about the UK's place in the world, but particularly the UK's membership of the EU. And I come at this from a very simple perspective, which is purely about business sense and the business rationale. Here in financial services, we attract more foreign direct investment than any other sector in the UK, and the UK attracts more foreign direct investment than any other European member state. Surely these two things cannot be purely a coincidence. These two things are indeed connected. But Blue, speaking as a US citizen, and certainly with a perspective from foreign direct investment, here we are after all in Chicago booth. How do these matters look from your perspective?
Well, from our perspective, we see what's going on in Europe, and we're a little nervous about it, and I'll go into that in a second. And then, London obviously is a great financial capital, which anchors the time zone, the continent, and its place in the global markets. Europe worries me because what I see happening in Europe is divisions getting stronger and stronger. There was kind of a coming together, and now it looks like there's a splitting apart. And I see a lack of leadership in Europe to really partner with the UK right now on some very vital issues. But Germans, for instance, they had an election in September. Chancellor Merkel won a lot of the vote, but she came 5 seats short of a majority in the Bundestag. So it's 3 months later, and she still really doesn't have an operating coalition. By the way, if you're interested in the reasons for that, in 2005, when she first won, she partnered with the SPD, and then in the next election they got crushed, and then she partnered with the Free Democrats, and in this election they got crushed. So it's not really a fun thing to be Chancellor Merkel's dancing partner in the government, because if anything good happens, she's going to get credit, and if anything bad happens, she's going to make sure you get credit. So the negotiations have been a little tough, but that means that Germany's not really quite ready to lead. And Germany really doesn't like to lead alone. They need a partner. And so let's go down the list of partners. They would normally join forces with France to kind of push Europe where they wanted to go. President Hollande is, if you believe the opinion polls, or if you just have dinner in Paris, you'll find out he's not very popular. And he's in no real position to lead. And Italy is trying to reform its whole government, and we'll see how that works. So right now, Europe is in a situation where they have a lot of critical issues, but they don't have the leadership to push things forward. And that comes at a time where the relationship is kind of tricky. So I guess that's the view, if you will, that we don't understand how it's going to work out because we don't even understand who's negotiating.
Mm-hmm. Yes. So thinking about that two-speed Europe you're almost describing there between those eurozone member states and the outs, do you see that position cementing? Do you think banking union is going to drive a stake through the heart of Europe, or do you see that actually Europe works best when there's ambiguity, when there's time, when these things just work their way through the system?
It probably does work. Well, some countries deal with ambiguity better than others. For instance, Italy has a long history of working through ambiguity with no problem at all. But the issue of the banking sector is very interesting. After the 2008 financial crisis, the U.S. Federal Reserve went in and bought $1 trillion of what we technically term as toxic waste in about 3 months. And it really helped the banking system get rid of their worst assets and start a fast recovery. The European Central Bank instead chose to provide liquidity facilities to the banking system. So it made sure that the banks had no problem with solvency and they could continue to function, but they weren't able to shrink their balance sheets and get on a more solid footing. So now 5 years later, we find the European banks are still somewhat undercapitalized. We're still going to have to go through another round of stress tests. And the EU is still worried about what do we do if a bank fails? And if the banking system isn't working well, the economy is not going to grow well. I mean, the credit system is like the oil in a car. If it's not fully upped and tuned up, your car is not going to run properly. And the European continent doesn't run properly, in part because the banking system really isn't set up to grow yet. So they're still tackling the last 5 years problem, and they're not looking at the forward-looking problem is how do you get these banks really functioning again and lending into the because Europe's about ready to grow again in terms of getting rid of its austerity, and the sovereign debt crisis is a little in the back. But they really haven't managed the next phase of banking system reform to encourage growth. They're still worried about a disaster.
Nice. So thinking more parochially about the UK and how the UK looks from a transatlantic position, given your expertise, having worked here in London before,
yes.
And now you're a regular visitor to these shores, which I'm delighted about, and CME obviously a major investor now in UK PLC. Mm-hmm. Is the UK still an attractive place to invest, bearing in mind these wider discussions?
Well, we've certainly we have a nice little office off of St. Paul's, and several hundred people here, so we're invested here. But it's a great place for an exchange like ours to anchor the a global presence. You really have to be in every time zone. You have to be in every region. You have to be in every market. And if you think about what exchanges do, you bring obviously buyers and sellers together, but it's not like you're bringing them together in the old way. 95% of our business or more is electronic, depending on the product, and we could be anywhere. It doesn't matter. So we actually have, we have a team of IT specialists in Ireland, and we have people here, and Singapore, and Hong Kong, and Beijing, and so forth. So it's a global market, but you still have to anchor things, and London is certainly our choice for where to anchor here.
So still an attractive place to make an investment.
That's an awesome, yeah. And in the finance sector, obviously, it's really the only place to be.
Blue, could I ask you first, maybe to address the Detroit points, and we'll come on to EU.
Yeah, the first question was about what's going on in the U.S. municipalities and states, particularly with some financial distress in Detroit and some of the states, and any lessons from the EU. The really big issue in state and local finances in the United States are pensions. And it's interesting because that's actually the really big issue in the European countries is when the demographics are that you're aging, and by the way, aging is not a bad thing. There's nothing wrong with it, but you do have...
Better than the alternative.
Yes, but you do have to realize that those long-term liabilities are actually a little shorter now, and you're a little more interested in them, and the costs to the governments... So in the United States, we had a lot of what I would call creative accounting when these pensions were agreed to. And so the assumptions about how long people would live and the cost of living increases and things like that have turned out to be pretty wrong. And so the pensions are considerably more costly, and at the same time, certain state and local governments are less able to pay them. Detroit is a particularly unusual case. Because it really was the heart of the U.S. auto industry, and then naturally that auto industry started putting factories all over the world, or at least in different countries. And Detroit actually used to have almost 2 million people, and now it's less than 1 million people. So they have a lower tax base on which to deal with some pretty generous benefits. Now, the people that accepted those or thought they had those benefits were generally taking fairly low-wage jobs. So they understood that they would take a lower wage now and get a better retirement. So it's a really tough political situation to figure out. But, the money is not totally there, and they're going to have to reorganize, and they're going to do it. Detroit is really, though, a lot of other municipalities and states have a similar, if not quite as bad problem. And that will be the big issue in municipal finance in the U.S. for the next decade of dealing with that problem. It's certainly an issue in the EU as well. If you look at the different budgets of the countries, their retirement, social safety net programs are some of their most costly programs, and there are going to have to be some changes because the money's really not there. So that's one to watch. It does have an implication, though, for Europe. You know, in the U.S., we have states that are really very, very different. I was born in the state of South Carolina, and it's absolutely nothing like New York or California, which are not like each other. And yet we have a common currency that works quite well. And in the European Union, they have some countries that are really pretty different from each other. Greece from Portugal, from Germany, from the Netherlands, whatever, any two you pick, they're quite different. And so I don't think that's the issue for the common currency. I'm moving into the next question about EU banking here, but you know, to make a common currency union work, most people would have argued that you really needed some kind of common fiscal policy. I don't think that's actually the case. When the euro was born, it did have a birth defect. But the birth defect wasn't the lack of fiscal policy union. Again, I go back to the US model. South Carolina, California, New York, they can't print dollars, and they have to balance their budget over time, and they work it out. And that's the same thing in the EU, except that when they put the Maastricht Treaty together to get the weaker currencies to agree to be inside this thing, and by the way, the big beneficiary of the eurozone was Germany. It allowed Germany to export more to its partner countries at a fixed exchange rate, because before the Spains and the Italys would devalue their currencies and compete Germany out of it. So Germany was the big beneficiary. To get other currencies in, to come into the euro, they agreed to let their banks treat the sovereign debt of any country inside the EU as equal on a credit risk basis. So if you're going to tell a French or Italian banker that Greek and Portugal and Spanish and Italian and French bonds are all the same as German bonds, they're going to buy them. So you've really got to get EU banking reform. You've got to get better capital controls. And actually, I would do it in a very simple way. I would just raise capital requirements and not have 1,000 other rules. And let the banks figure it out. But they're going to have 1,000 rules and higher capital requirements. And it's going to constrain banks. You know, they're going to make sure banks are safe, and then they're going to make sure banks can't function. And so that's going to be problematic. Anyway, I kind of toured that subject.
Yeah. We're just through the third plenum of the 18th Party Conference with a much more ambitious reform agenda put forward. And Blue, what's your take on this? Is this the start of the new dawn? Or is it just going to take such a long time before the West sees a big change?
No, I actually think change is coming faster in China. And it's interesting. I always get nervous when some U.S. politician goes to China and tells them what to do, because first of all, it's not a great example you're not dealing from strength, and in my opinion, on certain issues. And they're not going to want to hear that anyway. But the main reason I think China is changing is because they actually, for domestic reasons, it's very important in their transition to do so. They spent the last 30 years modernizing a country faster than any major country's ever tried to do that. And they did it with state-run finances building infrastructure projects, or state-run companies. And they had so much spending on infrastructure that as a percentage of GDP, 30 years ago, consumption was about 60% of GDP in China, and GDP was kind of small per capita. And now, infrastructure and all of those things and investment has gone up to 60%, and consumption is down to 40%. And that's a very low percentage of the economy, and so they need, for their own reasons, to become a more domestically growth-oriented economy. So that's one thing that's happened. And you get to, you can put so much infrastructure in and you get diminishing returns. And they're definitely there. They've probably overbuilt in several areas. So the leadership understands that. The other thing they did, they wanted to slow down their population growth, so they instituted the one-child policy, and 30 years ago. And people always ask me, well, why don't they just change it? Well, of course, the new leadership did just change it. But I will tell you, I've talked to a lot of doctors, and they tell me there's no way to create a 30-year-old without waiting for 30 years. So they're not going to have the change in one-child policy affect anything in my forecasting lifetime. you know. And so it's probably a help. By the way, it's not even going to change things that much because they have an entire generation of kids that have grown up as only childs, and that's what they know and actually like. And so it's not clear that they're even going to have more kids. So that's going on. So China has its own reasons to kind of have reforms right now, and they are embracing a more domestic-oriented economy, but that means giving their people more freedoms. That means allowing the market to have a little more action. And the only way for their markets to work properly is to connect them with the world, because if they have an isolated price, it'll give them the wrong answer, and they'll have bad resource allocation. So, you know, we're going to see more active participation of different sectors of the Chinese economy and the various exchanges they have, like the Shanghai Futures Exchange or the others, and more interaction with global markets. And London has, by the way, a great role to play in that, because a lot of the transactions will go from here to there as well as from there to here. And so there's going to be it's going to be a wonderful revolution. I'm very impressed with this new Chinese leadership because they really do seem to get it in an interesting way.
Yes, and I think to echo your comments, this is going to be a step-by-step process, but quite a rapid one. We've already seen the Shanghai Free Trade Zone. We've seen the quota being established, which I think was a huge win. We talk about it for being for London, but actually, from my perspective, it works across the whole of the UK, because I'm sure it will create jobs around the UK and also generate extra growth across the nation. So it's hugely important, as is access, going back to the conversation we were having a moment ago, as is access to euro liquidity, because of course the Chinese currency will need to trade and settle against currency. Sterling will be part of that, but so will the euro. So everything goes back to banking union at the moment.
It is an interesting thing. The Chinese have purchased, you know, give or take, $2 trillion worth of U.S. Treasury bonds, and that certainly has helped finance. So there's 17 trillion of U.S. Treasury debt outstanding, which roughly equals the size of the U.S. economy. And so that's been, thank you very much. You know, it's been a really a good purchase, but it made very good sense for the Chinese to do that. During the last 30 years, part of the infrastructure building that I didn't mention was a rural to urban migration that goes on in China. There's about 15 million people a year that leave the farm and come to the city. That's one London built every year. And that's a lot of additional spending. But by the way, if you don't provide those people jobs, you're going to have some political issues. And so one of the ways to provide jobs is to encourage exports, and one of the ways to encourage exports is to manage the currency effectively, and the way you do that is you bought the US dollars. So I look at the reasons that the Chinese bought US dollars is totally for their own benefit. I don't think they had any interest in financing US. And by the way, a question, you made a side comment on US fiscal responsibility. One of the things you might not have noticed is that the U.S. budget deficit is heading towards 0% of GDP. It was $1.4 trillion in 2009, deficit spending by the U.S. government, almost 10% of our GDP. It's down to 3%. This fiscal year, we're going to have about a $450 to $500 billion budget deficit, which is still large, but we'll get down to 3% of GDP by this fiscal year. Which, by the way, was the Maastricht criteria. And we're going to be below that by the time we have presidential elections. So the U.S. has actually gotten its fiscal house in order, way more than the world realizes. So, you know, I'm going to set that one aside. I can't leave that one there. But, you know, the last part of your question was kind of what's the global reserve currency. And the euro is clearly challenged because of the fiscal issues going on and the banking sector, and the fact that it's not really a growing dynamic economy right now. The dollar is challenged because the Federal Reserve has set zero interest rates as far as the eye could see, and that's, you know, it's not quite so clear that you want to own that currency if you were putting a portfolio together. You want to own some of it, but maybe not as much as many central banks do. The RMB is not a viable alternative because it's not fully convertible. Now that we think will happen in the next 2 to 3 years, and so by 2020, the RMB will start having a growing but small role in central bank portfolios. And then central banks spent the last 20 years buying gold, and interestingly, they stopped last April when the price collapsed, and I can't see them buying much gold anymore because it's not working in their portfolios. So you really, the big thing that central banks are likely to do, given that there's a little bit of flux here in what the reserve currency should be, is they're going to do more portfolio management as opposed to picking one currency and putting it all there. So there will be some erosion of the US dollar, but not in favor so much of the euro as in favor of lots of other currencies. And then they may allocate a little more money to their sovereign wealth funds, because that's kind of part of the country's wealth. And those things are less liquid and more diversified. So the real challenge to central bank management or the reserve currency system is actually portfolio diversification. And they will do more of that. And the RMB will become a part of that when it becomes fully convertible and not before.
So do you see that we are heading into a world, a 4Rs world, of the real, the rupee, the ruble, as well as the RMB?
Some of those will find their way into portfolios of central banks. If you're if you're an emerging market country and you've tried to manage your central bank over the last 5 years, you've had incredible risk, predominantly coming from the major countries. And that's still the case. I mean, if you're thinking about how to run Mexico or how to run Brazil, one of your big risks is what's the impact on your country from zero interest rates in the US. And as they do that, they turn to some of their trading partners. And they may take small positions in those countries. Actually, let me take 3 minutes and do a quick world tour here so that you get the views out, and then we can stimulate some more questions. India is an interesting one. Obviously a huge country that has had a very large bureaucratic influence, which is no doubt partly because of where we sit today. But they have made some interesting changes. They put in a new head of their central bank. I think he's from the University of Chicago. I could be wrong on that, but they clearly want to make some reforms that could take them in a very powerful direction. They also have some elections coming up, and it's not quite so clear. These elections might change the game a little bit in India, so we're watching the politics quite carefully. The Congress Party has lost some popularity. So India looks like, to me, a country very much in political transition, financial reform transition. I mean, the changes that could come from the central bank over the next 2 years are fairly huge. We have to see, because he was just appointed, but he's saying all the right things. India, by the way, if you're into gold, India is the largest importer of gold jewelry, and but they also have a huge current account deficit, so they've tried to slow those imports down, and they've raised tariffs on gold twice in the past year, and so that's another reason why maybe gold hasn't done as well. I know our next section is Japan, so let me just say.
I'd like to branch over into, as we're in Asia.
See, if we're in Asia, one of the things that Japan, we talked a little bit about aging a minute ago and the pension problem in the US. Japan is pretty much the oldest major industrial country around. Its average age is in the 40s, which is old for a country. India, for instance, is less than 30. They have no population growth at all. They have a slightly shrinking labor force. And if you think about it in terms of GDP arithmetic, if your labor force is not growing, all of your growth has to come, GDP, from labor productivity. And that comes from employing more capital, better technology, making investments. But really, on a decade-long average, about 1.5%, 2% a year is all you're going to get out of that. That's really, I mean, you can have a better year or a worse year, but trying to do that any faster than that doesn't tend to work. Which means, at least in my view, that if Japan can get 2% GDP a year, it's doing quite well. And it was actually doing that in the 90s and 2000s until 2008 showed up. So I actually don't think Japan lost a decade. I think it was dealing with its aging crisis. And therefore, I think that Abenomics may not work so well, because he's trying to do something that I think is nearly impossible. He's trying to make a country go faster than its natural capabilities. And the bump in the road that he will first hit is going to be on April 1st. I think you do celebrate April Fool's Day here.
We do.
The sales tax goes up from 5 to 8%. If you were going to buy a car and you knew it was going to be 3% higher on April 1st, you would buy it in January, February, March. So they're going to have really good GDP numbers in the first 3 months of the year, and then they're going to be terrible for the rest of the year because it's all been brought forward. And the country's going to slow down, and there'll be another round of stimulus, and then the yen will be weak again. And of course, none of these things may happen because I'm not allowed to give investment advice. But it would be a country that I would take some caution about. And if you're into options, one of the things we love in options theory is when we have a time frame in which something is going to happen, and then we can put options together before and after, and April 1st would be your day. So whatever happens in February and March, don't extrapolate it in Japan. Mm-hmm. And then the energy question. One of the greatest revolutions around is what's going on in oil and gas production. You can like it or not like it for environmental reasons, but it's out there and it's happening. And so the U.S. has 40% more natural gas production than we did 6-7 years ago. Well, what have we done with that? We've consumed it all domestically, and it displaced coal. So what we did is we took our electrical power plants, we turned them over from coal to natural gas, or at least to some extent. We also bought some municipal transit buses and power them with natural gas. And so natural gas is it's generally a little cleaner fuel than coal, but then what did we do with the coal? We exported it to Europe and China. So we've doubled our exports of coal, so it's kind of an unintended consequence of that. And then we have all the crude oil that we found, and it overwhelmed the infrastructure in the U.S. to move it to the refineries. So you have some dislocations in the prices, but we're working on that infrastructure, and that will be resolved. So you have the U.S. being a lot closer to energy independence, and that has huge impacts on global politics, because you then ask yourself, well, who's going to be buying the Middle East oil? And the answer is China. Mm-hmm. So it puts both the Indian Ocean and the Pacific Ocean in interesting play. So we're going to have some enormous changes because of this energy revolution. And of course, there's tons of shale gas in northern England if you want to get it. Mm-hmm. And there's actually even more in France, which they probably won't get, but we'll see. Oh, well, question of China-UK relation. I have no idea what the Chinese think of the British. I'm not going to get into that one. But, it is China looks at the world through the prism of a 5,000-year history. And I had the pleasure of hearing former U.S. Treasury Secretary Henry Kissinger talk about that. In the 1970s, he was sent over to China by President Nixon, and he really opened up China to a U.S. conversation at the time. Mm-hmm. And he was saying, if you go back to China today, and he's been going there for all these 4 or 5 decades, he just doesn't believe what's happened. It's just an amazing growth story. But the Chinese have really adopted a view of understanding the rest of the world. They have studied the UK, they have studied the US. And by the way, the country that they really don't want to emulate is what happened in the Soviet Union. And they study that even more. So I think they understand what's going on in our economies perhaps a lot better than we may give them credit for. And certainly that our politicians typically give them credit for, that they really do have a great understanding. But they also, their political process moves somewhat slower. This new leadership, though, seems to want to move a little faster. So they know they have to build bridges to Europe and to the UK. The eurozone is their largest trading partner, and it's part of the reason their growth decelerated, because their largest trading partner decelerated. Nothing they can do about that except diversify their exports, which. And to the extent that they want to integrate their financial markets more with the rest of the world, which I think they need to, and they've kind of agreed with that, they're going to be here, and they're going to be in Chicago, and they're going to be in New York, so forth.
And I do think it's for London and other places to build the bridges with China. Expecting to rely on our historic basis of competitive advantage to see us through this latest global shift simply won't be enough. So we commend the work of the Prime Minister and other leaders in getting out there and exporting the UK message, the London message in particular. Now I'm trying to bring this back together by thinking more about world trade. It's an issue that's back on the political agenda thanks to the WTO agreement recently. And I think the best way that I'm looking at this WTO agreement is a natural response to the series of bilateral and trilateral relationships and agreements that have been taking place. Top of that list for me has to be the TTIP, the Transatlantic Trade and Investment Partnership. And I'd just be interested in your views on how discussions on TTIP are going down in the US, simply because I've been to Washington and New York over the course of the last few months trying to push the message of TTIP being worthy, being absolutely worth the candle, and trying to get it done on one tank of gas being the mantra we should all sign up to. Of course, we need financial services to be on the table if we're going to achieve regulatory coherence. The ideal, of course, is regulatory consistency,
Yes.
but back in the world of what's achievable, regulatory coherence sounds like it could be a possible win out of TTIP. What's your view?
I'm a little more cynical, I think, on how these things develop, but I'm not as worried about their long-run implications. I think the financial markets in particular are so globalized that the central banks really form the backstop of coordination. When something's not going right, these people get on the phone to each other. They do a much better job of that than our elected political leaders. They don't always agree, and they do different things, but there's a level of coordination in that fraternity that I think provides some backstop, if you will. The political situation in Washington is very complex on trade issues. When the U.S. economy isn't growing, and this is true of lots of economies, but when the economy is not growing so well and people are worried about jobs, political popularism can take over and immigration becomes a topic, and it's very hard to do anything that might involve greater imports, and that's the way some people would see a trade deal. Of course, it also involves greater exports, so it's the wrong view, but it's the political. So politically, it becomes a little harder to do trade deals. So from 2008 till now, it's been difficult to deal with immigration reform. It's been difficult to deal with trade issues. We have done one or two bilateral deals in this period, but it's been difficult. I'm looking at a much more confident U.S. economy. I see the Federal Reserve getting out of its quantitative easing. I think they were in it way too long, and it didn't create any jobs anyway. Another topic. But I think that we've gotten a fiscal agreement, and you might have thought, well, it's a puny little agreement, but they did agree, and they've kicked the can a whole year and a half down the road, which gets it conveniently past the next election. So we've got a little better thing going on in the U.S. The economy, the unemployment rate is coming down. So I think from the next Congress, after the November 2014 elections, will be able to take a look at trade negotiations and do things a little more aggressively than the current one can, which is largely deadlocked on nearly everything. And so anything they absolutely have to do, they just do a little bit, do what they have to do and move it on, and then they'll fight it all after the next election. So for the U.S., I think that the trade issues come to the fore in 2015, but if they come to the fore when we have a healthier economy, we may get a better outcome for global trade.
Yes. Yes. Well, I know the political cycle in the U.S. always surprises Europeans just by how brief it is, because we move from midterms into lame duck presidency.
Actually, our cycle is not brief at all. It's a total continuous function. The moment that President Obama won the election in November, and I do mean the moment, immediately you saw 6 or 7 Republicans and 6 or 7 Democrats figuring out how they were going to reposition themselves to be run in 2016. And you can interpret a lot of their statements in that light. One of the issues with our political cycle is it doesn't stop anymore. We don't even have a little breather.
Well, time, ladies and gentlemen, is against us. I'm about to ask Blue for his prognosis for how the next year looks in terms of global growth. And then I'm afraid we will have to bring the session to a close. So, Blue, in a few sentences, are you optimistic for global growth? What do you think is going to go on in that powerhouse of global economy in the US, and what will be the implications for the rest of us?
I am an optimist going into 2014. I've been an optimist before. It's not always the best place to be, but I am much more comfortable. A lot of the deleveraging that had to occur after the financial recession of 2008 is pretty much finished everywhere but in the EU, European banking sector. But the U.S. is poised to have a decent year, 3.5% real GDP growth. The U.K. is poised, I think, to have better growth than is generally expected here. At least the European continent is no longer shrinking in an economic perspective. They might grow 1%, and of course that'll be quite uneven, but at least it's a little bit of growth. Countries like Brazil and Mexico and India have decelerated a lot, and they look like they're going to start back. It's nothing like what they were doing for the last decade, but at least they'll have a little better growth. China may still slow down a little bit. China's decelerating to a more natural rate of growth, but no hard landings, solid growth, just not, they did 10% for 30 years GDP growth, and then they've slowed down to 7.5, give or take, and I see them gradually, incrementally slowing down a little more, but that's the natural process of not doing as much infrastructure because they don't need as much. And you get diminishing returns. So that's a healthy slowdown. That's not a bad one. So I look at the world economy. I look at the inflation part. We had a drought in the U.S. and some other agricultural problems a couple of years ago, 2012. Corn prices went through the roof. Everybody in this world planted corn or a little bit of wheat. We have no issues on inflation from agricultural products coming unless we have another weather issue, in which we will eventually, but they're hard to predict. And energy prices, the only way you forecast really high oil prices is that you blow up something. And so, really with the additional supply and a little slower growth out of the emerging markets, we have very comfortable position in the supply and demand for energy. And the real action in energy, by the way, is in the segments. Natural gas. If I give you $1 and ask you to buy BTUs in the U.S., if you spend it on natural gas, you get 300,000 BTUs, and if you spend it on oil, you get 80,000, or even a little less. That's a huge pricing gap, and we solved that by building more refineries and putting pipelines in and shipping oil and things to different places. But if you buy a dollar of natural gas over here, you're going to pay 3 times as much as in the U.S. and 4 times as much in Japan. These are the things that are going to excite the energy industry, is to moving this stuff around, equilibrating the energy content of oil, electric power, hydroelectric, and then the alternative fuels, the renewable fuels, are not out of the picture because technology is bringing the cost of those down very dramatically. So the energy world is going to be in flux, but not because we have super high prices, but because we have price differences in the energy content of all the fuels, both regionally and in the different kinds of fuels. So it's going to be a very fun thing for markets and for people like me to watch.
Excellent. Thank you very much indeed. And I share your sense of optimism. Thinking back to where the city was this time last year, the optimism this year is palpable. So I think we're all looking forward to a stronger performance over the course of the next couple of years. Not to say we're out of the woods, and there are definitely issues to be addressed, but actually back on the up is certainly where I am. Well, with that note of optimism and sense of perspective for the future, I'd like to thank you for your time. I'd like to thank our hosts, Chicago booth, CME for yet another excellent event, and of course Blue for letting us have an insight into the world of the macro global economist. Blue, thank you very much indeed.
Thank you.
Ladies and gentlemen, thank you.